Do you think it's that bad? You think more than 99% of companies are not exit ready?
It's terrible. I've never seen a company that was exit ready. And how much they sold, they'll tell you exactly how much they sold. Then you say, well, how much money did you actually earn? And that's where the deer in the headlights there comes. Now, why is the lower middle market so interesting? Is because you have a huge discrepancy between the knowledge of the buyer and the knowledge of the seller. You sold the company, and now you buy back a percentage of it. Sold 100%, now you buy back 30%. It becomes an investment just like any other investment.
This is going to be a real nerdy question for you. C Corp versus LLC. Asset purchase versus stock purchase. QSBS versus don't go the C Corp route.
First of all,
All right, welcome back to The Formula. I'm Peter Roth, and I get founders who've built big things to expose their secrets that made them rich. So grab a pen. My guest today is Claudio Villas, the guy who tells roofing company owners that private equity is not coming to save them. He's a Miami-based M&A broker who specializes exclusively in multi-million-dollar roofing companies, and he just landed a strategic partnership with Job Nimbus. While everyone else hypes the private equity gold rush, he says the easy money era is dead, and owners are making terrible decisions based on nothing but hype. Today, I'm going to get his exact playbook for when to sell and when to walk away. Claudio, it's a pleasure to have you on today, sir.
thank you, Peter. Thank you so much. It's a pleasure to
Boy,
be here.
You and I've crossed paths a few times,
We have. I was going to say we tried to do this a few times, and I don't know, like the 10th time is a charm, I guess. And I'm glad we did it. I'm glad
Yeah,
we
me
did it.
too.
So I'm
Me
happy.
too. Well, look, I want to jump right into it. You've got a really interesting story. I'm an immigrant. You're an immigrant. I love that part about us. I think it makes us very unique. You moved from Argentina to South Florida. You built a really unique niche, brokering roofing companies. So walk me through that stretch where you went from immigrant hustle to closing multi-million-dollar roofing deals.
Okay, well, it starts way back when I was a little kid because I started my first business when I was 18 years old in Argentina. And my first
Okay.
business was actually to teach English to executives from American companies. So I would teach
Nice.
English to, I don't know, American Express executives, Gillette executives, IBM, and so forth. I can give you a whole list of them because
Yeah.
I started when I was 18 and I sold the business when I was 26. So when I sold it, I joined Johnson and Johnson, which was I think the best decision I could make at 26 years old, because they took me as a sales rep and they gave me an opportunity to make a fantastic career. I love that company. I always, in all the podcasts and all the meetings that I have, I always praise them because they taught me not only about business, because I was able to actually, oh God, do financials, do marketing, do sales. I did a little bit of everything, operations, IT. Believe it or not, I was director of IT for 2 years. Not sure how I got that job, but I did it. And beyond that, they taught me a lot about business ethics, and I'm a huge fan of making sure that every decision that you make it ethically. uh, and After that, when I turned 50, I decided that was enough of corporate life, and I wanted to do something on my own. And I left J&J with kind of like a golden parachute, if you will. And I started selling companies, any type of companies. By the way, I came here because J&J brought me here, so it wasn't the typical hustle. I was fortunate enough to actually be brought by the company, and they took care of all the legal stuff and getting my green card and everything. Me and my wife, because my wife
I,
was here.
I need to interrupt you. How did you go from? I feel like there's a quick jump. So how did you go from? You said I went selling company, selling company. How did that happen? How did that path go to selling? That's a weird jump, right? Like most people don't get into selling companies until they've learned a lot about the business world, right? You can't just wake up out of high school and say I'm going to start selling companies. Like no, you sell companies when you're old and gray, like you and me. So how did that happen so fast?
Yes, it doesn't look here, but it's very gray there too. Well, like I said, J&J taught me about business a lot, and I mean a lot. And
And what is
I
J and
also
J?
went to college. I'm sorry,
What is J&J?
Johnson and Johnson.
Oh, Johnson.
Uh,
Okay, you saying
yeah,
as if I. Yeah, sorry. Sorry, I'm
yeah.
not clear
Sorry,
like
sorry.
you. Yeah. Okay. Okay.
Johnson and Johnson is one of the top companies. It's
Sure.
Fortune 500, whatever.
I mean, for yes.
But what it is a huge school, and it's not only a huge school for business, it's also, like I said, for business ethics. I'm very happy to have gone through 20 plus years with them. And that's where I learned everything I know about business, because I did literally everything you can do in a business, because I moved international, I did marketing, I did sales, I did finances, I did a little bit of everything with J&J. Every 2 years I would change jobs. And my big passion is actually small business, even though I was working with a large business or like Johnson and Johnson. But I really am passionate about small business, because I believe that the small business owner has the horrible deal. I mean, being a small business owner is not for everybody.
Right, real quick, if you run a home services company, you can download my free scripts for roofing, HVAC, and plumbing, like the actual scripts being used by the hundreds of agents across all the 75 plus call centers that we've built. Just click the link in the description and we'll send it to you right away. Okay, back to the podcast.
And people don't realize that. Um, So when you are the head of a company where all your money is in, all your future is in there, and you have on your shoulders the fate of your family and many other people's family as well, which is all your employees. The kind of responsibility that is not easy to bear. And I know how business owners actually, struggle to get a business up and running. Thing is that I'm a huge fan of business owners, because I know that they have always the raw deals. Business owners, not only they have all the world on their shoulders, their family, their employees, their suppliers, and everybody else, and they get paid at last after everybody else gets paid. That's when you get paid, because you live on the profits of your business. So I see them as heroes. And I always wanted to help. So for a few years, I actually was a volunteer with an organization called SCORE, which actually helps people to become entrepreneurs. But I was a volunteer, so I didn't make any money, and I gotta make money. So I decided to help them exit, and exit for the best deal that I can possibly get.
Love it. Okay, this one's a little spicy. Everyone says private equity is buying all the roofing companies, and you think that's a
Yeah.
myth. So walk me through what's actually happening in 2026 that most owners are getting completely wrong.
Yes, well, I think that unfortunately, social media has a strong bias, and you hear what you want to hear from social media, and when it's out there, it's really not true. Yes, it is true that private equity is buying companies. It's not true that everybody's selling. If you remember Thomas Beck's famous graph, that's about a very small percentage of the market. And last year, there were only 200 companies sold out of 80,000 companies that we have. That's a small percentage. Now, many of them are very media, attention seekers, and they get it, but it's not what it looks like. It is important to understand that private equity is coming, but there's got to be a balance, right? Like everything else, it's got to be a balance in seeing what's happening, and not seeing only one side. The truth is, and this has not changed, and it's not only in the roofing industry. Out of 100 businesses that are put on the market to sell, only 20% sell, and 80 will not be sold. And that is typical, right?
And those are the
Yeah,
ones that
if you
actually and those are the ones that actually go to market.
Exactly. From the
Okay.
ones who go to market, 20% get sold and 80% don't. Uh,
Jesus.
Statistics could vary between 70 and 80, but that's basically it. So you want to sell your business. It's not that you're going to answer that email and that you're going to sell it immediately. It's not going to happen. If you talk to the big private equity groups out there and you ask them how many companies do you interview before you actually buy one, and again, if you talk to Thomas Baff, who I talked to last week, he's going to say that last year they had 400 meetings with 400 different companies, and they bought exactly zero. If you talk to other private equities, they talk to 100, 200 companies, and they eventually buy one or two at the most every year. So that's the truth. And that's what people need to really understand.
Hey, if you want Scalify to help you build out a fully managed outbound call center for you so you can have a team of people booking in home appointments for you, Check the link in the description and book a call with my team today. Now, keep in mind, we only build one call center per market, per industry. So don't sleep on this, or we'll probably just end up helping your competition. And I'm betting you wouldn't like that too much. All right, back to the podcast. Let me ask you a question. At what point does private equity take interest? If you're a roofing company right now and you're interested in potentially exiting in the next few years, just so you as Mr. Roofing Company owner can understand better, at what point does private equity start to take interest in your company? At what EBITDA does it become a potential private equity deal versus just a strategic buyer acquisition?
That's a really good question too, because people think that just because you have a truck and a ladder, private equity is going to be looking for you, and it's not true.
Yep.
The minimum EBITDA out there is typically $1 million in EBITDA. Okay, some of them go a little bit lower, but that would be the I would say the threshold. And many of the ones that I've been talking to have been increasing that to 1.5 and $2 million as minimum in EBITDA. But EBITDA is just one part of the
Of course.
equation. The other one is that the company has to be ready to sell. And 99.9% of the companies are not ready to sell,
You
unfortunately.
think it's that bad? You think more
Oh,
than
it's terrible.
99% of companies are not exit ready?
It's it's terrible. I've never seen a company that was exit ready. I see them that they're close to, and then we work for a couple of months with them, and then we go. But at least the ones that I've talked to, there's always things that you have to tweak, that you have to work on. And again, it could be a couple of months or it could be a year. But exit ready, because the first thing that you need to do is to have really strong and well organized financials.
Of
And
course.
that's where the biggest issue is.
So that's exactly what I was about to ask you. So what is the biggest issue? So obviously books. So of the companies that come to tell you, hey, Claudio, we're ready. Trust me, bro, we're ready. We got all of our shit lined up and we're ready to exit. What are they still missing? What are the top three
There,
things? Even the companies that think they're ready are still not ready for.
Yeah, it again, it goes down to financials, and their financials are typically in cash. No matter how big the company is, they keep the financials in cash, and buyers will look at the financials in accrual. Then many of them don't have enough information on accounts receivables, accounts payables, their working capital, their job costing, WIP. Uh, Again, not all of them are lacking them, but none of them have it 100%, all their ducks in a row. There's always something, and that's why I typically work with other partners that we help them get that ready for when the due diligence comes. And that's the other thing, Peter. Most deals, they get all the way to the due diligence, and that's where they die. So, because you're not ready for due diligence is a huge deal. There's hundreds and hundreds of documents that you have to share with the buyers, and sellers are also not ready for that.
Would you say the primary reason that these companies are not ready is because they haven't hired the proper team yet to become exit ready, and so they're walking in without proper guidance?
Yes, I think that's a big part of it. And it's not only about a team to sell the business, it's a team to actually make the business more profitable, make the business more efficient. Um, and again, it's I'm not saying anything about the owners. The owners have a lot of balls in the air that they have to juggle, and typically this part gets forgotten, unfortunately, because I think it's very important. But most business owners are using their accounting just to pay less taxes, and they don't grasp
Yeah.
the importance of having a strong information kind of system, right? So if you really take accounting as an information on the health of your business, you can make a lot better decisions. And you can, of course, make your business ready to sell, but you can make a lot better decisions for management of the business that most people don't even pay attention to. Again, I'm not saying anything about the owners. I'm saying they have way too many balls in the air, and they don't pay attention to that one, which to me is a shame, because if you think about it, and this is another statistic that I always use, and I use it because I learned it when I was in SCORE, is 50% of the businesses will fold within the first 5 years. And 82% of those that will fold because they didn't understand how capital flows through their system. A company is a system where capital comes in and capital comes out, and whatever's left is what the owner receives. Unfortunately, there's nuances there that most people don't look at.
And what are those top nuances?
Well, if you think about it, I'll give you an example that I actually did in a presentation to Owens Corning just a month or so ago, and it opened the eyes of many people. Let's suppose you have a company that makes $6 million a year, and your EBITDA is about 5%. That means that $6 million come in, five and you receive only 5%, which you only get $300,000. Okay, so we put a question out there in the presentation. I say, okay, well, let's suppose you want to increase your revenues, and what would you do? And we give them four options: you increase your price, you decrease your price, you increase your marketing expense, or you decrease your marketing expense. And when we talk about price, I'm not going to go through the whole thing, but it's very simple. One of the things we said is, okay, well, let's reduce price to sell more. Okay, we reduce our price, we expect to sell more. The question is, how much more do you actually need to sell, not to have higher revenues, but to make the same amount of money, the same $300,000? If you do the math, to do that, you actually have to grow 50% your sales just to get back to making $300,000. Now, if you're thinking about the top line, you probably are going to say, okay, I'll reduce 10%. I don't know, I'll make one more million. But if you do that, you're going to be losing money. And the way you really need to look at it is from the bottom up, not from the top down. Because companies that are strong are the companies that get a 10 to 20% profitability. And most people are not thinking about that. First of all, because the whole world takes you to look at the revenues and not the profit. And second of all, is because it's a lot easier to think about revenues and not profit, because you got to do a lot more math and you got to dig a little bit deeper. But profits are what actually drive the company, not revenue. Now, if you have two companies, you have a $10 million company and a $5 million company, and the $10 million company makes $1 million in earnings, and the $5 million company makes $1 million in earnings, the $5 million company is a lot more valuable than the $10 million company.
Of course.
Yep.
Let me ask you this.
Yeah.
Let me ask you, and I totally agree. Yeah, to me, I find it incredibly amateurish when anyone is talking about their top line revenue. I'm like, that's just that's a vanity number at best. It's a completely meaningless number. I've seen plenty of companies that are claiming two, three, four, $5 million in top line revenue, and they can't pay their bills. Happens all the time. It's
Absolutely.
it's a sad state of affairs. It happens all the time. So, then my question for you is, what do you think is a healthy percentage? What is a healthy net profit margin for a roofing company if they want to become a potential private equity acquisition target?
That's a really good point. The minimum would be 10%. Okay.
And
Healthy would
that's
be,
bad, right? That's bad.
yes, yes.
That's bad.
That was real. Healthy would be between 15 and 20%. That's a nice number. And it's not that hard to get, Peter, but you need to pay attention to everything. The problem is, again, you know, the shiny object syndrome. Now everybody's talking about AI, and I'm seeing owners just investing money in an AI without knowing how that's going to play out, and it's great AI.
Yeah.
Before that, it was, I don't know, creating your website. Before that was SEO. Before that is, I mean, there's always some kind of shiny object that you're following, but you got to understand how that plays into, again, not your revenues, your earnings. If you're increasing your expenses, how much more you need to sell to get back to where you were before. So that's what you should be looking at. And again, unfortunately, you know, talk to any roofing or any other small business owner, and you ask them how much they sold. They'll tell you exactly how much they sold. Then you say, well, how much money did you actually earn? And that's where the deer in the headlights stare comes.
Love it.
Or
Here's a
ask
question.
my accountant.
Yeah, there you go. All right, here's a question that everybody wants to know. Claudio, tell me, what is the difference between a business broker and an investment banker? What is the real classic definition between the two? And who the heck do I call? And when do I call them based on my EBITDA?
That's a really excellent, excellent question, and I'm gonna take a few minutes to explain that because it's very
Please do.
important. Um, The market, the M&A or business selling market is divided into different stratas, if you will. The first one, which is the bottom, which is the typical, I don't know, hair salons, stores, restaurants, and what have you. That's called Main Street because it's businesses that are Main Street. And some small businesses, a small roofing company would be in that place, right? When you're making, I don't know, a couple of $100,000 in earnings, up to $1 million in revenues, and I'm giving you just ballpark numbers.
Yeah.
That is what's called the main streets. That's where a business broker actually starts. And I was a business broker for many years. Now, even though it's called the roofing biz broker, what I am now is called an M&A advisor, which is a second level. An M&A advisor works in the lower middle market, which is one step above the $1 million in EBITDA companies. Now, this is a very interesting place to be at, and I'm going to tell you about it a little bit later. Okay, I'm going to go to the third level. The third level is the higher middle market, and then you have the top one, which is the Fortune 500, public companies, and what have you. In the higher middle market and the top companies, that's where you have the investment bankers. Okay, now in the middle, that's where I am, where you have an M&A advisor. That's where the most interesting part of the whole process is. I love where I am right now because it's really interesting. It's a really challenging situation. In the lower strata, which is the main street, you have a buyer and a seller that are very much in the same level. Okay, the buyer and the seller are typically owner operators. They know the business, they work in the business. There's not a big discrepancy. When you go beyond the lower middle market, which is the higher middle market, or Wall Street, if you will, where you have those investment bankers, also the buyer and the seller are on the same level. The buyer is really versed in the financials. The seller is versed in the financial. Now, why is the lower middle market so interesting? Is because you have a huge discrepancy between the knowledge of the buyer and the knowledge of the seller. Here is the only place in the whole marketplace where the seller is typically very well versed in the operations of the business. He understands how to manage the business. He does the trade and so forth. And the buyer doesn't know much about that. But on the other hand, the buyer knows a lot about buying businesses, a lot about financials, and the seller doesn't know much about that. So that's where you have a huge discrepancy, and that's where people like me and other M&A advisors really add value, right? Because now you're talking to two different people that have completely different views of a market or of a business, and you have to find a way to get them to talk to each other the right way. Yeah. Uh, so uh, this is to me the most interesting, the most fun, the most challenging thing you can do. So again, you talked about business brokers, lower, the main street. M&E advisors, where I am, lower middle market. Investment bankers, higher. And investment banking has a lot more um, processes. It's a lot more difficult. It's a lot more. It takes a long time. I was part of one of the acquisitions with Johnson and Johnson. It took over 2 years, and we eventually didn't even get to close it. That's where investment bankers they have a huge a group of people and so forth. In our case, we have a smaller group of people, but our challenge is so much more interesting.
Let me ask you this. Thank you for explaining that. Let me ask you this. If you've got a roofing company right now, I don't care whether it's, lower, whether it's a, maybe it's just a strategic acquisition target, right? Something in the lower, few $100,000, or potentially a lower middle market, private equity acquisition, a couple million bucks. What team do you recommend that the seller put together right away before they even take this thing to market? Tax people, lawyers, who do you recommend that they start putting together right away?
Exactly. And that's the first thing that we do when we get a company that wants to go to market. Number one, an accountant that knows what he's doing in the M&A space, not an accountant for your taxes, an accountant that will help you through the M&A space, because we can talk about the nuances of M&A accounting and why. many owners that try to do this themselves, then they they uh, they get taken for a ride. Um, then the second one is an attorney again that knows about M&A. It's not the same to sell your house or to get divorced or I don't know, having any other legal issues than M&A. M&A is a very specific type of attorney that you need. Then a wealth manager, because you want to make sure that you keep as much money as you can after the sale. There's a lot of tax strategies that a good M&A um, uh, tax specialist will help you, so you can keep number one, keep as much money as you can, and number two, once you keep it, you know how to invest it after the sale, because you're probably going to get a windmill of what is it, a windmill, no, a
Windfall.
whirlwind, windfall, that's the word.
Windfall.
Thank
There you
you.
go. Yeah.
Thank you. Windfall of money, and you really need to know how to protect it, right? So those are
Us
the people
immigrants,
that I'm going to help.
us immigrants got to help each other out, with our
Yeah,
they visit
thank you,
speech every
thank
once in
you.
a while.
Yeah,
Yeah.
English is not my first language, even though I taught English for many years, but you know, it's always that. Anyway, so that's it. You need at least those people, and don't forget to actually work with them before you put the business on the market. Get to know them. Well, typically, what I do is I give you the list of three or four that I know that I worked with in the past in other deals, and I know they're good. And then you communicate with them. You touch. I give you also a questionnaire to ask them, so you know how to evaluate them, but don't do this without a team, because the buyer is, especially if you're selling to private equity, the buyer is going to have a lot more people on their side than you do. And that just by showing up, they have a huge advantage over you.
Makes sense. Okay, let's talk terminology here. Roll ups, portfolio, platform. Explain to my audience what these words mean. Are they similar? Are they different? What does my audience will need to know?
Well, yeah, a roll up is basically a strategy where you take one, two, three, four, five companies and you add them all together and you create a group, a portfolio of companies. What private equity tries to do is to make sure that they hedge their bets. So you will see that most of the time private equity will buy, I don't know, a company in Florida, another one in Texas, another one in Oklahoma, and they try to spread out their portfolios, because if a dry season comes to Florida, that could be saved by a great season in, I don't know, Texas, whatever. So it's balancing out, and that's a really good strategy for any kind of investment. In private equity investment, that's one of the things that they do. And some of them are buying companies that are uh, commercial, and some of them are looking for residential or what have you. So they roll them up. And what they do is they typically, okay, there's many different strategies, but the typical strategy would be, okay, I have four or five different companies in different markets. Now, what I'm going to do is I'm going to centralize some of the operations, like, for example, accounting, HR, marketing, and all that. I will keep the name and the positioning of that company in that area. Again, not all the time, but most of the time they will keep it, but they will centralize and, of course, lower the cost. That way, they increase the EBITDA. Again, that's what a good uh, business management does. Okay, so lower the costs so you can increase your EBITDA, so you make your company stronger. So they buy them there, and they get several of them. And then once they have a higher EBITDA, then your multiplier is bigger. So you have a double whammy in the value of the company. And now they turn around and they sell it to a bigger fish, if you will. So their job is to take as many companies as they have, make them as profitable as they can over 5 years or 7 years, and then they sell them. That's a roll up. Now, the way it starts, it typically starts with one company that's called a platform company. That's the bigger company typically, and it's um, as best prepared for growth as you can. So they're looking for really strong companies to become one platform. And then to the platform, they do add-ons. So they have a larger company. Those are the ones that are probably $4 or $5 million in EBITDA. They buy that one, and then they start looking for smaller companies to add them on to that platform. The important thing on that is that most of the time the owners stay a couple of years, they become part of the management, they help each other. So now, rather than being you on your own in your own company, you become part of a bigger group. Now, people like it, some people like it, some people don't like it, but they become part of a bigger group of businesses that are working together. And if a year doesn't go well for you, well, it's going to go well for somebody else. Now, that's the the um, the strategy, and that's what they're betting on. Sometimes it doesn't work out that way, but that's basically it. Did I answer all your
Yeah.
questions?
Oh, that's great. No, thank you. That's great. I know a lot of people are really just unclear about that. Let's talk about earnouts. Or tell my audience what an earnout is. Does an earnout apply at the smaller level where we're talking just business brokerage, or does it only apply really when we're talking private equity acquisitions? And what are your thoughts on earnouts?
Okay, so before going directly into earnouts, let's talk about deal structures because earnout is part of the structure of the deal. Typically, you will have, if you're talking with private equity or private investors in general, you're not going to get your money all at once in your pocket. Unfortunately, it ain't going to happen, no matter how much we try. And I have many sellers asking me, can I get 100%? And the answer is, unfortunately, no. There's going to be some portion of cash up front, which is typically around 70%, 80%. And then the 20, 30% remaining is going to be in some kind of structure that's not going to be cash. So the structures are seller financing, earnouts, or rollbacks. Okay. So let's talk about seller financing. And here's one thing that I would like to do is I would like to actually break a few myths as well, because many people think that okay, if I do seller financing, I am a more I am safer, right? I'm going to get the money no matter what because now I'm doing seller financing, so I'm getting some kind of interest for my money, 7%, 10%, whatever you agree. So basically, they would pay you 70%, and let's say 100% of the rest is seller financing. You do seller financing for the next 5 years or whatever, and you get a percentage of interest. And it seems like it's a very safe bet, right? But it's not so safe, okay? Because if everything goes to pieces, the likelihood of you getting that money, no matter how how much you try to protect yourself, is really small. Okay.
Really?
Yes. So you gotta be very careful. It of course has to do with who the buyer is, what kind of warranties they put. But the truth is that if everything goes to pieces and your business tanks, it's not gonna be that easy to get your money. So it's not as safe as it looks. But on the other hand, your if the business grows, you don't have anything on that growth because you're gonna get only um your interest. So if the business doubles, triples, hey, you get your interest 5, 7, 10%. That's it, right? So your upside is really capped, but your bottom side it's still very very risky. Okay. The second one is earnouts. The earnouts are basically a payout for achieving a certain uh, target. It could be based on revenues. It could be based on EBITDA. It could be based on specifics that the buyer wants to focus on, like for example, I don't know, increasing retail sales, or in improving or gaining new markets or whatever. There's a lot of different ways you can get an earnout, but basically is a an incentive to achieve a target. Okay. Now there's different types of earnouts. One of them is the one that buyers typically try to use is okay, if you achieve it you get it, if you don't achieve it you don't get it, so it's all or nothing. You need to negotiate that, right? Because you don't want to have an all or nothing. You want to make sure that if you're, I don't know, one penny below, you get something. And if you're, double of the target, you get more. So there's ways to negotiate that. It's a very important thing that you need to negotiate. So that's an earnout, basically a target and a incentive to achieve that target. Um, if you're going to do something, I don't think it's the best deal for the seller, to be honest. But sometimes you use it to to bridge a valuation gap. So the seller wants, I don't know, 10 million, and the buyer can only afford nine, or if he's not going to do more than nine, then you say, okay, well, we're going to use $1 million in an earnout. So if we achieve the targets that we want, you're going to get that million additional. That's what I think an earnout actually works back. And then you have a rollback. So basically, you sold the company, and now you buy back a percentage of the company. So you sold 100%. Now you buy back 30%, and now you keep 70% in your pocket and 30% in the investment. It becomes an investment, just like any other investment, which, in my view, is the best option for a seller. And the reason why it is the best option for a seller is, number one, if the company cags, well, you lost 30%. That's it. You put you have a risk of losing everything. But if the private equity actually achieves their purpose, which is typically double or triple the value of your company, that 30% becomes sometimes even bigger than the 70% you got at the beginning. So to me, that's the best opportunity for somebody to really make a lot of money. Uh, of course, it has its risks, but it's the only one that actually gives you the opportunity to grow with the company. Okay. And if you stay in the company for a couple of years, you will have a saying on how the company will grow, and will allow you to get a second. That's what's it called, the second bite at the apple. And some people do a second and a third bite at the apple, because when the company sold the second time, they can do the same thing. So those are the three main structures that you would have in a deal.
How often do you see when people who roll equity?
Yeah.
How often do you see that working out advantageously for them versus biting them in the ass? Instead of biting the apple, they get bit in the ass. A bite was still
Yeah,
made, just
that's a
not the
good
right
one.
one. Yeah.
Yeah, no, there were several very well, advertised, if you will, failures lately in the industry, because they failed, so they got bit in the ass. The ones that I've been working with, and be careful, because there's like a 5 year um, wait time until you do the second bite. Okay. So, and the industry has started doing this in 2020, 22. That's when the number of acquisitions started growing. And we're going to talk about that in a minute. So right now is when you're going to start seeing, is that second bite at the apple paid out or not. Okay.
Mhm.
So in general, it does depend on the buyer and who the buyer is. And we're going to talk about that very much in the next few minutes. It's very important that you not only have the good deal, but you have a good buyer. Many buyers at the beginning in the 2022, 23, they didn't know much about the industry. And like everything else, when there's a gold rush, there were a lot of bad decisions made on the sell side and and on the buy side. So you're going to see probably a lot more failures in the next year or two, because not because of today, is because they did the wrong deal 5 years ago, and sometimes they overpaid. Sometimes when they tell you they're going to give you a huge multiple for your company, sometimes that's not the greatest idea, because whoever bought you is actually getting a lot of uh, they need to get loans for this. So you have a lot of leverage put into your company. And if you have to pay back the debt and the company goes, like we're having in Florida, that we're not having any bad weather for a long time, then you got to pay those bank loans, and they get in trouble, and then you can fail. So sometimes a lower multiple in the long run is going to be a better deal for you, believe it or not. That's why you can't take anything face value. You always have to dig a little bit deeper. People that thought they had a great deal 4 years ago, now they're going to find out that the deal is not that great, because the buyer is not able to afford it, right? To afford the growth. So many of them will fail, many of them will succeed. Um, the ones that will succeed are the ones that are being bought today. And this is very important, because now the whole industry is maturing. The buyers are not as eager to buy a company as they were eager to buy last few years, where you had a truck and a ladder. There you go, they're going to buy you. No, now they're asking a lot more questions. I'll tell you, they're asking a lot more questions to buy a company. It's not like it was before. The way I see it, it's better, because if you have a good company, you're still going to sell it, and the buyer is going to ask enough questions not to get in trouble and to actually be more successful.
I love it. All right, we're going to go deep on this one. This is going to be a real nerdy question for you. Okay. C Corp versus LLC, asset purchase versus stock purchase, QSBS versus don't go the C Corp route and don't get double taxed and do the LLC route and play it safe. What are your thoughts on
Well,
that?
first of all, I'm not a tax advisor, okay, and I am not a expert in tax, but 90% of these deals are done on a um, asset based. It's not stock sales, okay. Let's get that started. I actually had one client that was asking me, "Can I do a stock sale?" I'm like, the buyers are not going to take your company as a stock sale, and the reason for that is liabilities. If you buy the assets, the buyer is a lot better protected from a liability point of view. If you're selling your stock, the buyer could be buying liabilities that you had that they didn't see, and it's a lot riskier. From a tax point of view, it's more it's better for the buyer to actually do an asset sell. It's better for the seller to do a stock sell in general. Okay, in general, that's what you would say. So sellers would like to do a stock sell, buyers would like to do an asset sell, but the one who typically will win here is going to be the buyer. C corporation, what they typically tell you is that a C corporation, you're going to be uh, uh, double taxed on it. So typically people try not to have a C corporation. It's more of an LLC. Then the quality of earnings QOV, I think you asked, that's a really big, deep dive into your company. I'm working on one right now just to give you an idea. And the buyer just asked for all the receipts of all the purchases that they did in the last 3 years. Okay, receipt by receipt. And it's like, and these are professional quality of earning companies. There's companies that only do quality of earnings, and that's the request that we got this week. And the seller is going crazy on how am I going to get all that? And if you don't have it, there's ways to negotiate it. But that's how deep they go. They will probably ask you, what did you do with this 200 expense 3 years ago in February, 2024? How the hell do I remember that? But that's the kind of thing that they do.
Is part of that, do you think, just a negotiation tactic? Is that just their way of going like, I know this is going to make them go insane and I know they're not going to have that information and I'm going to use it against them and drive the price down?
I'm not saying this one is doing that, but I will tell you that there's one very well-known strategy that buyers do that's called seller's fatigue or deal fatigue.
Sure.
And they drive you nuts, crazy, because here's what happens when you sign an LOI and you start to do due diligence and quality of earnings. You are kind of stuck with the buyer until you either close or you have to go another route. So you're not you cannot shop your business around. You have an exclusivity agreement with the buyer, and now the buyer is going to take as many opportunities as they have to demonstrate that what they offered you was too much, and now they got to pay less. It's a very well known strategy. Like I said, it's deal fatigue, and they drive you through the mud to try to get you as tired as possible. And then at the last week, they're going to say, "I love your business, but it's actually not worth 10 million. It's worth 8. You want to close next week? This is what we're going to be closing on 8." And you either accept it or think of going back to the grind with another one.
Yeah.
You're going to do the same thing.
Same shit all over again. Yeah.
So remember, we just said a minute ago, you really need to pick who your buyer is. And some of those buyers that offer you the moon when they want you to sign the LOI, they offer you the moon. They know they're not going to give you the moon,
Yeah.
and they're just they're dragging you down. So
Yeah, they have tricks up their sleeve that, but they just need you to they just need to wear you down until you run out of energy and just say yes to anything.
exactly, exactly.
Yeah.
And unfortunately, that's what happens a lot. And that's why, when we get offers, I always tell my sellers, before you accept an LOI, ask the buyer who the other owners are that sold to them, and give them a call and see what their experience is and see how much they like it. Because if the buyer says you can't do that, that's a really big red flag. Now, if they do and they open their books and say, "Hey, call anybody," they're going to be okay with telling you. Of course, not everybody's going to have 100% perfect, 5 stars, but you want to make sure that whatever they dealt with in the past uh, advocates for them, because that's a big, big part of the thing. Again, you're going to be with that buyer for at least a couple of years, so you're going to be a partner with them. You want to make sure that you get the right deal and you get the right also uh, the you know feeling. You want to make sure that you guys get along because you're going to be working together for a while.
As an intelligent seller, does a seller have to have an exclusive agreement with a potential buyer where they can't be negotiating with other potential buyers so as to avoid this exact type of problem? And can they just walk in and go, hey, just so you know, I'm not signing any exclusivity clauses with you. I'm leaving this open to other negotiations because I don't want to deal with, these tricks.
Good question. That's why you eventually need to sign an exclusivity agreement so the buyer will do the quality of earnings and the due diligence. You can't get away from that. But what you can do is negotiate before that. You want to negotiate before you sign the LOI. And that's one of the things that I tell all my sellers. Right before you sign the LOI is when you have the biggest leverage. Okay. So here's what you need to do. First of all, don't get stuck with one buyer. Have at least 5 to 10 offers on the table. See those first offers and do a really strong analysis of what they're offering, what the price is, what the terms and conditions that we discussed are, and who the buyer is. Those are the 3 pillars of a good deal. So you have to have at least 5, hopefully more, offers on the table. Once you have all those offers on the table, you negotiate one by one with each one of them to get the most out of it and to make sure that your buyer is the right person. That's after that is when you're gonna sign an LOI. Don't just sign an LOI for because somebody told you that they want to buy you. That is not gonna work. And that's where you're gonna get into those traps. Now, if you negotiate beforehand and you do the due diligence beforehand, and you create an LOI in which the buyer needs to meet certain milestones to keep the LOI alive, then you're talking about something else. If they give you an LOI that says you have an exclusivity for 120 days and it doesn't have any milestones to achieve, well, you're going to be stuck with that guy for 120 days and he's going to drag you through the mud, like we said before. Now, if an LOI says, okay, 15 days, these are the deliverables, 30 days, these are the deliverables, and I have the right to walk away if I don't like it, that's where you really need that's an LOI worth signing, right? That and
Hmm.
a lot of other things. Many people just gloss over an LOI and they just sign it because an LOI is typically non-binding. But LOI, if you do the right LOI, the LOI should take you from the signature of the LOI to the closing of the deal seamlessly. So you negotiate a lot before you sign an LOI. You have your attorney review the LOI. But I have an example right now. I'm working with another company here in Florida that the, uh, the first round the deal didn't go through, and the buyer wanted to sign another 90 days LOI, and the owner said no, forget it. Now we're gonna work with somebody else. So we're working with another buyer, and this other buyer, literally, their LOI is being reviewed by the seller's attorney. And I work a lot with the attorneys because I do the commercial part or the negotiation, but then I hand it over to the attorneys so the attorneys know exactly what to sign in that LOI and what to put there. It's very, very important, and many owners don't realize that. They think that just because they have an LOI, and that's the other one. They think that they just being because they have an LOI, that means that the deal's done. And it is way far from being truth. I mean, most deals, like I said before, not most, but many deals die at the due diligence part of the process.
All right. I'm Joe Roofer and I want to retire in 3 years. I want to either make $10 million off the sale of my company or 20 or 50. What type of EBITDA do I need to be showing? And what do those EBITDAs represent? Let's say, for example, at what EBITDA is it a 3x multiple? At what EBITDA? Does it become a private equity transaction and it becomes a 5x, 8x, 10x? What are those? I know there's no a specific answer, but what do those general numbers look like when a transaction goes from a private sale to a private equity sale, and what do those multiples look like?
Great question. And it's also important to demystify that, right? If you're a small owner, I don't know, you make $100,000, $200,000 in EBITDA, and that level is not even called EBITDA. It's called SDE, it's just seller's discretionary earnings. Um, which is different. And I'm not going to get into the technicality, but it's a little different. It's multiple of SDE when it's a smaller business. You're going to get a 2, 3 multiple. It's not going to be that great. When you go to the $1 million that we were discussing, that's for you going to the 4.5, 5, or 6 times EBITDA. Okay, $1 million, $2 million. That's where you're going to be to get to the next level, $9 million, sorry, 9 times or more. You gotta have a much larger EBITDA. It's probably 5, 7, or even bigger. And it's not only that; it's the whole company needs to be really well set for selling. Okay, so that's basically the number. And another thing that I'm typically, I always advocate against is, there's a million places where they offer you to calculate your um your valuation, and they come up with, oh my god, dozens of uh pages of an analysis that means nothing, because at the end of the day, the only way you know how much your company is going to sell for is by putting it on the market and getting the offers on the right people. The more offers, just like anything else, the more offers you get, the bigger the EBITDA, or the bigger the valuation or the multiple. So the just to try to guess what a price is without actually getting the input from the people that really matter, who are the buyers, in the situation that you are today. Like, for example, it's not the same a company that has been growing for the last 3 years and they get to a $2 million EBITDA than a company that has been falling for the last 3 years and they get to the same $2 million EBITDA. If your trend is down, the buyers are going to discount it. And they're gonna put a lower multiple. If your trend is up, buyers are gonna pay more. So, there's so many nuances to it that there's not really a silver bullet. There's averages, and I just gave you the averages. That's a rank where you're gonna fall. And if you get to the higher or to the lower part of the rank has to do with how well organized your company is, how transferable it is, if you have SOPs or not, if you have a good marketing plan or not, if the owner is in the business or on the business, and what's happening in the general market, right? So all of those are very important elements to take into account, and there's no tool out there that can actually predict all that. It's all fluff, and it's really. I mean, you get really nice um, reports out of that mean nothing.
Yeah.
That's. I'm sorry. I'm a contrarian sometimes. I hate
No, no, I love it.
for a ride.
All right, Claudio, you talk a lot about making businesses stronger, not bigger. What does stronger, not bigger actually look like in real practice?
Well, we discussed a little bit at the beginning of the conversation. A strong the bigger the earnings of the business, the stronger the business is, because it can support different variations in the market, right? If you have a business that really generates cash, and oh, one thing important, cash flow and earnings are two different things. Okay, so a strong business is a business that has strong cash flow and strong earnings. So the earnings fuel the cash flow, and the cash flow fuels the earnings. And if anything should happen within a year, you have the reserves to actually go through that without being, without going bankrupt. So the earnings and cash flow make the strength of the business. But not only that, it has to be a predictable business. You have to know that if you're investing X amount of money in sales or in marketing, you're going to get X amount of money in return. Okay, that's another signature of a strong business. Another signature of a strong business is that you have strong SOPs, and the processes don't depend on the people, depend on the actual process. So you can if somebody leaves, somebody comes in and they can replace that person. A strong business doesn't have any kind of concentration risks. And there's several concentration risks, especially if you're in commercial or new construction. They typically have a very big concentration risk. One big client makes 20, 30, 40% of your business. That is weak. You want your business to be spread out through many, many small clients, or geographically. We talked about that before. Why does the multiplier grow when you have different locations? Is because you have less geographic concentration risk. The other typical concentration risk is, of course, owner concentration. If the owner dies, the whole business goes, to hell. Well, then that is a concentration, lack of concentration, or diversification, if you will, is what makes a business stronger. Another thing that makes a business stronger is recurring revenue, which is in roofing is not that common, and I see a lot of companies starting to look into how to make recurring revenue with, for example, maintenance programs and so forth. That happens a lot in commercial, or it's more common in commercial. It's not so common in residential. But if you find a way to get recurring revenue, kind of like a maintenance or guarantees or something, that makes your business more predictable. Therefore, it's stronger. Therefore, it's more valuable.
I love it. Okay, you tell roofing owners when not to sell. So walk me through the profile of an owner who came to you ready to sell and you told him to walk away.
Oh my God, I wish it was less times that I have to say that. But I of course I sell businesses for a living, so I do want to sell your business, but I don't want to make you waste your time or sell your business that could be sold for a lot more money, just have a fire sale. So unfortunately, many owners come to me when they shouldn't be selling the business. And when shouldn't you be selling your business? When your business is on a downward trend, or it's not making money, or it's not making enough money. And that's unfortunate. Unfortunately, when they come to me to sell, and it's like, Claudia, I want to sell my business. Why? Because I'm not making any money. Well, if you're not making any money, who's going to buy it, right? It's a multiple of how much money you make. If you make zero, you can multiply zero for 1,000, and it's going to still be zero. And unfortunately, that happens more often than not. So don't sell your business if you're not making money. The best thing is to actually work on making it make money and do what we discussed earlier today. Look at the business from the bottom up and not from the top down. And you will find opportunities to lower costs, to increase prices, and to make that business profitable. Once you make it profitable, then you can sell it. The other thing that happens a lot is uh, younger people that they only had a year or two in business and they want to sell it, and they come to me. It's like, oh, $5 million. Well, it's too young to sell. If we put it on the market, they're going to discount the fact that it's only been a couple of years that you've been in the market. So my advice to them is, hey, hold your horses. You're a young guy, work a couple of years more, and then you sell it. Have 3 or 4 years in your belt, if you will, and have a strong trend, in growing trend. And again, not growing revenues and earnings both at the same time. If you show that, 3 years from now we're going to meet again, and your business is going to be a lot more valuable. Okay. Then unfortunately, there's other reasons why people sell their business, and it has to do with the partners not getting along well. And that happens a lot too, right? So, advice there is choose your partner more than you would choose your wife or your husband, because it's going to be harder to get rid of your partner than of your spouse. Okay. So those are the reasons why people sell and what I tell them not to sell. I would say probably more than 50% of the time I tell my clients don't, well, they're not clients, they don't become my clients, but I tell them not to sell.
Got it. So you just signed a strategic partnership with Job Nimbus. So what does that mean for roofing owners who are watching this? Like, how does it change what you're building with the roofing biz broker moving forward?
Well, we just were there last week. We're starting to put some ideas together to work together. I'm going to be learning a lot more about Job Nimbus. I can't tell you much, but we're working on uh, educational stuff for roofing business owners, so we can help you make your business a lot stronger than just bigger. Bigger is good, stronger is better. So I've been working and talking with Job Nimbus about that. I did a few social media things with them. We had 3 very good days. It was not only me, it was many other um, they call it content creators now. It used to be influencers, and I'm not an influencer. I'm just somebody that has a loud mouth and wants to you know help people. So I think Job Nimbus saw that, and they helped me with that. So we signed a um, strategic partnership agreement, but that's just the beginning. We're going to be doing a lot. I cross my fingers because I got a lot of ideas on that.
No, that's great. That's super exciting. So, I got another interesting story. So, you've got a story that you like to share about buying your first TV that you love that you love to tell. So, what was happening in your life, and why does that moment still matter to you today?
I think that TV that I bought was the reason why I became who I am today. And I'll give you the short story. I left my house when I was 18 years old. This is not uncommon in the United States. It's extremely uncommon in Latin America and outside the US. You typically live with your parents until you get married. I wasn't, of that upbringing. I wanted to do everything on my own, and I left my house when I was 18. And I told my dad, "Look, I don't want you to support me anymore. I want to see how far I can get on my own and what I can do with my life." And it wasn't about being a um, homeless or anything like that. It was really trying to see how far I could get. And I for a year or so, I lived in an apartment with zero, and I mean zero furniture. I had no furniture because I had no money to pay for the furniture, and I slept on a mattress on the floor. And I really, at that time, there was a color TV was starting to come up in Argentina. We had only black and white TV, and I really wanted to get a color TV. So I saved for almost a year to get my color TV. And I bought that color TV and I brought it home, and I got a hand down chair, and I put that color TV on the chair, and I watched TV from my mattress on the floor. And I thought I had a right. I am like, I
This is
said,
it.
"This is
This
it.
is it.
This is it." And it cost me so much, and I learned how hard things are. So now I don't take anything for granted.
Yeah.
I understand how hard things are for everybody, right? And how to when you have a goal and you want to go for it, you really put everything that you have to get there. So that's the story of the TV. I cherish it because it taught me that things are hard to get, and the harder they are, the more you enjoy them.
I love that. That's such a great story. From one immigrant to another, that's such a great story. You and I could probably share 1,000 of those types of stories. Okay, I want to shift the gears a little bit here, and we're going to move on to the formula questions. It's the name of this podcast, obviously. So I want to get down to the actual nuts and bolts of the things that are really that really make your business successful. So short answers, nothing terribly long here. I want you to maybe answer these questions as if you're talking to a young business broker who's just getting started and can use the help of a seasoned vet like yourself. Okay.
Mhm.
What's your best source of leads?
Networking by far, the
Networking.
referrals that I get. Oh yeah.
Okay. Name the one software tool that if it disappeared tomorrow would cripple your business.
It wouldn't be Job Nimbus because I don't use Job Nimbus, so that
Yeah.
that would be for a roofer. But the one that would kill my business right now because I'm using is Pipedrive, which is my CRM.
Your CRM. Okay. I hear that a lot. What's this, what is the specific book that changed how you think about money and success?
Well, my Bible, if you will, is the Seven Habits of Highly Effective People. I
Good.
think everything gets back to that. No matter what other book you read, it will get back to one of the seven habits. So that's my
Got it. Stephen Covey. One marketing platform or agency that has given you the highest ROI.
Bible. Oh, I have a beef with marketing agencies. Fortunately, I'm not working with anyone in the roofing ones. I like many of the guys in the roofing industry, but they're not um, brokers. Marketing. Honestly, I'm very disappointed at them. And my wife actually took over marketing and building our website and all that because we had really bad experiences.
Got it. Okay.
I'm looking for one, by the way. So if you know anybody,
Yeah, yeah, yeah.
Mhm.
Everybody wants to be in the right rooms and level up. So, what networking groups or masterminds do you belong to?
Well, I belong to many for the roofing and for the brokerage industry. I belong to the ABVA, to the M&A Source, to the Business Brokers of Florida, and what have you. I have not. I have left other ones that I was in because they were not roofing specific. So I was in one that's called Leading Peers, which is a great place. It's a company that you basically have your board. You have 8 other people, and you meet once a month, and that was a really good one, but it wasn't roofing specific. So I'd like to see something more roofing specific. My wife actually belongs to the National Aluminum Roofing, and she is, that's a great group of women, very interesting. But I just do the brokerage ones.
Do you have you got you know Lance Bachman? Have you gone to his conference called Build It to Sell It? That's usually in Florida.
I was there. I was there last year, and I was
Oh,
in a
I was there
podcast with
too.
Lance Backman too. Oh, I didn't see you.
I was there too. Yeah, I had a booth there. You should do a booth.
I
I
had a
think
booth too.
you did. Oh, okay. Well, shit. We must have walked right past each other. Yeah, yeah. I was there. I had a booth. Okay.
Yeah.
That's awesome. Okay, you're launching the Capital Thinking Academy. So walk me through who it's built for, what a roofing owner actually walks away with, and what the investment looks like, and who should not join.
Okay. So the capital thinking has to do with everything that we discussed today and how, and unfortunately, how unprepared companies are to be sold. But I'm looking at it more from a teaching a owner on how a investor would look at your company. So um, the idea of the capital thinking is to help the owners look at their business as if they were going to invest in the business. We created a character. His name is Mike Ramirez, and he's the owner of Ramirez Roofing and Restoration in Texas. And Mike has a history for, he's been in the business for 6 years, and he's going to be actually in the business for 9 years, and he's going to sell. And we're going to use everything that we know about managing a business the right way, looking at from the bottom up, understanding the P&Ls, understanding the balance sheet, and so forth. That's going to be part of Mike Ramirez's story, and it's all going to be online. It's a video. It's in Kajabi that we're putting it together, and basically, you will look at Mike's business, understand what the problem is, and then bring it to your business and do the same exercises in your business. So understanding how money flows through your business, which is, like I said, I think it's the least understood part of all business ownership, and it should be a lot better understood. So that's the Capital Thinking Academy. That's what I'm working with several companies to actually help sponsor and help bring it to the team. And many companies are already, interested in it.
That's fantastic. I applaud you actually for doing that. That's a really cool endeavor. Okay, lightning round. All right, quick questions. If you want me to skip anything, just say skip. Ready?
Okay, then go ahead.
What's your most embarrassing business failure that you can laugh about now?
Oh my God, I can laugh about it now, but I really almost went bankrupt when I thought I was a big shot, and I came out of J&J at Johnson and Johnson,
Yep.
and I thought I knew everything, and I bought laundromats, and I didn't realize when I bought the laundromats that they are actually screwing me, and I almost went bankrupt because of that. And laundromat is the easiest business to manage, man.
Yeah.
I can't believe you know what I didn't take into account? What's called the CapEx, capital expenses.
Yeah.
That's part of what I'm teaching
Shit breaking.
in it did because I bought a huge laundromat, and I was supposed to, or I had to change all the machines, and I just didn't have money to change them, and somebody came less than a half a mile away and put a brand new one, and it almost drove me to bankruptcy. I laugh about it now, but I believe me, I cried at that time.
So you mean Cody Sanchez didn't steer you in the right direction with her buy boring
She
businesses,
didn't steer
possibly?
me in. Oh yeah, no, no. You know what, Peter? There's no such thing as a boring business. Every business has its nuances,
Yeah.
and you gotta always. I mean, it's money, so you gotta be very careful with how you spend it.
Yeah. What's your guilty pleasure that would surprise your followers?
Let's see. I guilty pleasure. I don't know. I love ice cream, but I don't think that's very. Let me think about it. Let's bring it
Sure.
back.
Yeah. 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 Okay. What's the best personal item that you've ever spent money on?
My set of golf clubs. I became an obsessive golf player lately, and
I just,
that's
I,
the one that I love.
I just took a golf lesson this morning.
Oh, good, good
Yeah.
for you.
Yeah.
No,
Yeah.
it's
Yeah.
great.
Okay. You work with your
I'm
wife
still
every
thinking
day.
about the guilty pleasure. Sorry.
Yeah. Yeah.
Go
Yeah.
ahead.
Yeah. It's okay. All right. You work with your wife every day. So what's the one thing that she does in your business that you'd never admit out loud that she's better at than you?
Most of the things, but she's amazingly good at putting presentations and financial analytics together, following up and really digging into the depths of the financials of the companies that we sell. If it wasn't for her, my what's called the SIM, confidential information memorandums, wouldn't be as good as they are, and she's straight at it.
That's awesome. All right. You moved from Argentina to Miami. What's the one Argentine thing that you refuse to give up no matter how American your life becomes?
Barbecue.
Yeah.
There's one thing that I will not give up is barbecue.
Yeah.
We love doing that here, and going to sleep late at night and having dinner at 9 o'clock. I can't get used to the 6 o'clock. I've been here for 20 plus years, and I still can't get used to having dinner at 6 o'clock. To me, it's like that's tea time. It's not.
Yeah, yeah, yeah. All right, well, let's get back to the barbecue thing because this is an important subject. This might be more important than all the other things we talked about today. Because I love me some good barbecue. So I've had some Argentinian barbecue. What is it that makes Argentinian barbecue better in your eyes than boring old American barbecue?
Well, first of all, you're using real wood for the
Mhm.
barbecue. That gives it a completely different flavor. We don't add the sauces that barbecue sauce. Our meat is just put salt on the meat and then put it on the grill and take a very good care of it. We eat a lot more things that are usually here in the U.S. So, for example, we eat, this is fairly common, but not very. It's sweetbreads, which is really good. Then we have kidneys. We have other things in the barbecue that make it better. And chimichurri is the only sauce that we actually typically use.
Mhm.
It's great, but it has to do with using actually wood for the barbecue and not gas. Gas is
Okay,
really.
okay, but Americans like their wood, like their smoked barbecue. So what about like going to like a good old Texas, real authentic Texas barbecue place and getting just some killer brisket or some killer ribs
Oh,
without all the
yes,
extra sauce, without all the extra sauce?
yes,
Because I agree with you.
yeah.
I hate all the sauce. I want my meat. I hate all the bullshit sauce.
Yes, I agree and I like Tex I love going to Texas and having Texas barbecue. It's not the same because it's in Argentina, it's not smoked. It's open. But yeah,
Yeah.
I like it. Mhm.
Yeah, man, I had never been to like a real authentic Texas barbecue place until like literally a few months ago. It was my first time ever in Austin. I was like, all right, I'm in Austin. I gotta go to like some of these big name barbecue places. And I went to like two of them. I mean, it was noticeably better than anything here in the like noticeably better than anything in the Denver market. And it's like crazy because it's not, I mean, it is complicated, but the ingredients aren't right. Wood and meat, like we have all that, and you can get that anywhere, right? It's like, how the hell do they have it so figured out over there? I could not figure it out. So, all right.
Yeah.
I don't normally do this, but I know you've got a couple questions that you wanted to put me on the spot on. So, what were your questions that you had for me?
I I do, but I'm gonna tell you about my guilty pleasure because I'm not gonna
Okay, let's hear
you
it.
let
Let's
me
hear it.
you let me out too easy.
Okay.
Uh one of the things I really like to do is I like to put people on the spot in general. Okay,
Mhm.
that's my guilty pleasure. I
I'm
like
nervous.
to,
I'm nervous.
uh, yeah, and that's why we're gonna have these questions. But how can I put this? And it's not in a mean way. I like to make an impression, and I like to typically find things that people think are one way and come up with a different way. And you, is it clear? I don't know if it is, but
Nope, but
I
let's hear it. Let's hear it.
how well, I'll ask you the questions and then I'll explain. So,
Okay.
I read that one of your viral strategies for getting prospects to trust you involves a video about dog poop. So, what is the dog poop story? And has anyone in the home services world tried to copy you and ruined it?
Ruined it? No, but I don't use it myself. I use it for my call center clients. So when we build out a call center for our clients, I go through a long onboarding process. It's typically a 3-day long onboarding process with my clients. And part of that strategy is in how to get the highest show rate, right? How to minimize cancellations and how to minimize no-shows, because that's always an annoying factor in any sales driven organization, period, right? Especially direct to consumer type stuff. And so we're always trying to train them on how to minimize cancellations and no shows. And part of the way to do that is to build up the KLT, the know, like, and trust factor. Right. And so what I instruct my clients to do is I have them send a very personal, very organic, not produced, homegrown video with their cell phone, literally just walking down the street, just introducing them. So when someone books an appointment, let's say a prospect books an appointment with you, right?
Yeah.
And you want to make sure that they actually show up to their appointment, right? Because in a lot of industries, especially B2C, no shows and cancellations can be a real annoyance, right? Can be a real problem. Some industries, it's up to 60, 70, 80% no shows. It's a real problem. And so you have to quickly make a lasting impression on the prospect. And so one of the things that I have my clients do to build up that KLT, that know, like, and trust factor and the safety factor, because a lot of homeowners, especially put yourself in the shoes of like a single mom, right? If you're a single mom, that is the hardest avatar to get to show up to the appointment because she's thinking some burly blue collar guy who stinks like cigarettes and's got dirt under his fingernails and has a teardrop tattoo and a list of felonies out the door is going to be showing up to your house tomorrow to do your roof inspection. And you don't want him coming to your house because it's just you and your daughter at home alone. And that's crazy. Why would you want some crazy, guy? Why would you want some felon showing up to your house? You know what? I'm just going to no show because that's the safer thing to do, right? This happens a lot. It happens all the time. So you got to send this mom a video, a very personalized video. And so what I usually have them do is I want this video to be like super organic, not produced. Don't rehearse it. Don't practice it. I always tell people if you record this video and you didn't make any mistakes, you made a mistake. There's the mistake. Go back and re-record it and manufacture a mistake, a funny one. Make a funny mistake. I don't care if it's you walking down the street and you bump into a light pole, like make yourself look a little stupid. Like that's people love that shit, right? It makes you relatable, it makes you friendly, it makes you human. So but the way that I have them do it is I say, hey, take your dog for a walk right after they ate. And then as you're sharing this little personal video, right when your dog starts pooping, you stop the video in the middle and right in the middle and you go, "Oh my God, here I am trying to be all serious introducing myself and my dog decides to do this." And you flash your camera on the dog pooping. And of course, the dog's going to look up at the camera. Right in the middle of the poop, it's going to
Yes,
look at
yes,
it,
yes.
right? And now the homeowner is going to see this and they're going to be like, "Oh my God, this is the funniest shit I've ever seen." You know?
Mm,
Like, and now that's it. Now they can't be scared of you anymore. They're not afraid of you anymore. Now they know you, they like you, they trust you because they can see, oh, he's not this scary felon. He's a really nice guy and he's funny and he's got a dog. Right?
amazing.
Now you're the opposite of scary. So that's how I like to involve pooping dogs.
I love it. You know what? I might use it myself.
Do it. It's so fun, man. And because here's the thing. Here's what I always tell people. It's like, look, if you don't do anything like that, or if you send something that's really boring and corporate and just professional, hi, this is Peter with XYZ Roofing, and we're a family staple in your community since the 1600s, and we do good pricing and honest work, and we clean up after ourselves, and we have a perfect 5-star review, and we're with the Better Business Bureau, and blah 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 blah. Blah. I mean, no one hears any of that. Nothing because you sound just like everybody else. And when you sound like everybody else, The only way people can remember you by is, guess what? Your price.
Yes,
That's it.
exactly.
And now you've just
I love it.
commoditized
I
your
love it.
now you've just commoditized yourself down to price. So you need to find a way to make yourself memorable in a way other than price. People don't buy from the
It's
cheapest. People don't buy from the cheapest player. Rarely do they do that. They buy from the person that they know, like, and trust.
exactly, exactly. And I love it because that again, it goes to what I wanted to say about my guilty pleasure. I like to put people a little bit uncomfortable. I like to be kind of like a renegade and come up with things when they are very stuck up and they're bring that's exactly what I was referring to. So I guess you and I have a lot more in common.
Yeah,
It's always nice to have a different angle, something funny, something relatable, something not so stuck up. And when you find people who are stuck up and you can actually get them to out of the comfort zone, a little bit uncomfortable, that's the guilty pleasure for
yeah,
me.
love it. I love it. All right, what's your?
Um,
Well, yeah, I guess you
now,
had another question for me. Okay,
yes, yes. You've told the story about overseas call center management trying to extort you for $100,000, right? Roofing guys deal with insurance adjusters, contractors who disappear in mid jobs, and all kinds of characters. So, on a scale of difficult roofer to international call center villain, where does that guy rank?
street level thug. That's what I'd say. I'd say like street level thug, right? It wasn't the most like sophisticated hijacking of all time, but it was
Mhm.
aggressive. It was aggressive and it was nasty and it was dirty and it was scammy. I mean, it was scammy and disgusting and slimy and all those things. So I mean, yeah, I wouldn't rank him as like, a high level sophisticated mastermind, but it was like, it was like high level thuggery for sure.
Great, great.
Awesome.
Thank you for
Claudio,
that.
man, thank you so much for being a guest on today's podcast. This is fantastic. How do people find you online? What's the best outlet for someone to go find you?
Well, I'm always on Facebook and LinkedIn, Claudio Vilas. I'm also always on my website, which is www.theroofingbizbroker.com. They can
Cool.
call my cell phone, 954-774-4141, or email at claudio.vilas@theroofingbizbroker.com.
Awesome. And we're going to put all that contact information down in the description. So if you want to reach out to Claudio, learn what your company is really worth, learn how we can help you out. And by the way, if you do want to do that, do it now. Don't wait until it's too late. Don't wait until you're already tired and then your profits are going down because then no one wants to catch a dropping knife. Don't call Claudio then. Call Claudio 3 years before you're ready to sell your company at least and start engaging with him now. Claudio, is there any other thing you want to share with my folks?
No, no, Peter, it's really a pleasure being with you. I'm happy that after a few months going back and forth, we actually made it.
Yes, sir.
Really, really enjoyed it.
Great.
This was a great, great conversation. It's been an hour and a half almost. I thought,
Yeah, man, we had a lot to talk about.
yeah, yeah, it's great. I
Awesome.
want to see you when I go to Denver, and hopefully you'll see me when you come down here.
We'll go play some golf together.
There you go. There you go. Thank you.
Thank you.